This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.
Please speak as you might to a young child or a golden retriever.
It's an unfair game.
They're schemers. Schemers trying to control their little worlds.
The rich get richer, that's the law of the land.
It's just money.
Blasphemy! This is madness!
I drink your milkshake.
Hello, everybody. Welcome back to another episode of Milkshakes Markets Madness. I'm John Katsmita. This is Brent Johnson. If you're new to the show, please head on over to milkshakespod.com. If anything about our name is unfamiliar, if you've never heard of the Milkshake Theory, I think you will be enlightened quite a bit with the information we have on the website there. But here we're just going to dive into topics that are both maddening and financial market related. Brent, how we doing? It's been an interesting week.
Yeah, it has. It's the quarter end, and it's been quite a quarter. You know, we've talked before about violently sideways, and that continues.
Yeah. So speaking of quarter end, there's been a number of themes. It's crazy how time flies, but it's also crazy how these conversations can kind of compound, and then you're referring to things, or we are referring to things, and talking about concepts that seem very, very kind of ingrained and familiar to us, but anyone coming on board might be like, well, what are they referring to? So I think, you know, as a quarter one comes to an end, why don't we recap some of that? And one of them you just mentioned, violently sideways. Do you want to put some color as to what you mean by that?
Yeah, well, you know, it's something, I think it was kind of towards maybe the end of January to the middle of February. We'd had a huge run up in the first month. We had started to have a pullback into the middle of February, and then we went up and we went down and up and down. We've just kind of gone back and forth. We haven't really gone anywhere since the end of January. So it's made big moves. When I say the markets, all these different markets, and I'll refer to them in a minute. But with the exception of the NASDAQ, which has finished higher than it was at the end of at the end of January, and the DAX, the German index, which is just slightly above where it was at the end of January. All these different assets are below where they were at the end of January, but they're all, for the most part, up for the year. So, but we haven't really gone anywhere since January, but it's been very volatile. And to be honest, I kind of think that continues. I don't trust this breakout in the NASDAQ. I want to trust it, but I don't. And because I don't trust it, I haven't participated in it. So to anybody out there saying he's just upset because he didn't participate, you're right. I am upset that I didn't participate. But part of the reason I didn't participate is I think some of the stuff we're going to talk about later, you know, what could go wrong, and being careful and not getting caught on the last tick of a market that's got ahead of itself. But if I just go through these quickly, like the Dow is flat for the year. This is as of the close on Friday, March 31st. The S&P is up 6.5%. The NASDAQ's up 20%. The DAX is up 14%. The Nikkei is up 6%. Hong Kong index is up 2.5%. Oil's down 6%. Treasury bonds are up 4%. A lot of people were saying the death of bonds, right? Those are up 4% for the year, and they're paying a pretty nice dividend. Not horrible. The 10-year is up 2.5%. Gold is up 8%. Copper is up 7%. Brazil is up 1%. Shanghai's up 5%, and Korean index is up 8%. So everything has done pretty well. The only thing on this list that is down is energy. I should have put nat gas on here because it's down as well. But let's think about this. Let's think back to a year ago, when we had just had, maybe a month prior, the invasion of Ukraine by Russia. Gold was through the roof. Oil was through the roof. Nat gas prices were going to go to 20, and everybody was going to go cold in Europe. And now, and equities were going to crash and stay down, right? Well, here we are a year later. Equities are not too bad. They're up for the year. They're not too far below where they were a year ago. But the thing that's down is energy. Now, I don't think too many people thought commodities and energy were going to be down a year later, a year ago. And the only reason I'm highlighting this is because one of my pet peeves is people who are so certain they know what's going to happen, right? And I think this is just another case where, the most certain trade, buy energy, has been wrong for the last year. Now, it doesn't mean it will continue to be wrong. It doesn't mean the people that are calling for it to go higher will be wrong. It just means that everybody who was certain a year ago that it would be much higher a year forward were wrong. And so, I've gotten many things like this wrong myself, and it's taught me not to be certain about anything. And I think that's one of the things we continually come back to on this show. Be open to different ideas, however crazy they may sound, but don't necessarily get certain about it, and don't necessarily buy into it just because you read something that sounded smart. Think about it, and don't just accept everything that you hear as fact.
Awesome. And some of the things that you're just drawing attention to as far as what these various indexes have done, how they've performed, I want to come back to that. But while you're on this topic of certainty, especially when it comes to the crowd, right? There's so much enthusiasm around certain things. And for whatever reason, I don't know why the human instinct is to at least in financial markets, especially in FinTwit, to get so wrapped around doom and gloom. And look, I went through this too, as someone in the real estate, I run a mortgage company that I, built and started at the heart of the financial crisis in 2009. It literally took me a decade to shake free the shackles of this end of the world double dip, phenomenon that everyone was waiting for in 2010 and 11 that never came, and starting to have this mentality of being open-minded, like you're talking about, and not having this grabbing onto things with certainty. And we see this everywhere right now because something like a violently sideways markets just breeds uncertainty, and people cannot handle that. And so one of the things that I'm seeing in relation to that right now is everyone is now jumping on this end of commercial real estate. And this is another one of those things where it's like, if the problem is so big and so obvious, like kind of the idea of Europe going dark and cold and energy blowing through the roof in terms of pricing on everything. And it's these types of things that are just, the more obvious they become, it's almost like the less likely they are to occur. Do you have any thoughts on kind of that theme of like how the crowd gets it wrong in commercial real estate?
Well, I think in general, you can't be a contrarian just to be a contrarian, right? I think it's always good to be skeptical, but the reason a trend will run is because most people are in it, right? So you can't always be contrarian. But I think it's always good to be skeptical. And the point is if everybody does think the same thing, then probably there's not too much thinking going on, right? And so I do agree. When everybody agrees, I automatically start to at least think about how we could all be wrong. And I'll give you a very good example. At the beginning of this year, I was saying that I expected kind of by the end of the Q1 into Q2, we were going to have market volatility and probably some kind of violently down as opposed to just violently sideways. And, as we got into March, it looked like that was going to be right. And it still could be right. But I also said at the very beginning of the year, the thing that scared me about my view was that everybody seemed to have it. Right. And, if you look at sentiment and you look at different positioning and stuff like this, at the beginning of the year, everybody was bearish. The put call ratio, everybody was loaded up on puts. Nobody was buying calls. And so then what did you have? You had a short squeeze. Everything ran higher. 2 or 3 weeks ago, everybody was bearish again. And now what have you had? You've had a short squeeze. Everything runs higher. So I'm not surprised that this has happened, because I'm always trying to think, how could my view be wrong? But I'm also not chasing it because I still have conviction that my view is right. Now, that said, I'm not just sitting on the sidelines. I'm not one of these people, to your point, I'm not one of these doom and gloomers who says you should just sell everything, go sit on the mountaintop in Montana for 10 years and come back when it's all over. That sounds actually kind of nice, but I just don't think that's the right way to do it. So, I'm in the markets, our clients are in the markets, but we are being very cautious because we just don't think that this is sustainable without some volatility along the way. And so it doesn't mean that you can't, when it's a risky environment, and I've said this before, but because we're doing a recap, I'm going to say it again. When you have a risky environment, it doesn't mean you can't make money. You can make a lot of money in a risky environment. It's just that you're taking an outsized risks to do it. And it's in that type of an environment where you can experience a very large drawdown. And so whenever we get into that type of an environment, I tend to err on the side of caution. And if we trail what the markets are doing a little bit, so be it, because when the downturn inevitably comes, we won't participate in all of that either.
Yeah, and speaking of recaps, it was something you did highlight multiple times earlier in the year that this was your view, but not that everybody was on board, but there was a majority consensus, and that kind of made you nervous. Speaking of recaps, the last time you said sitting on a mountaintop with gold in Idaho, and now it's Montana. So we're not really sure where you're going to hide out in the end, but
I don't want you guys to know. It's a secret.
Yeah. It's going to be a mountain, and it's going to be cold, and there's not going to be anybody there. Speaking of, before we go any further, you might actually be in some cold mountains next time we do an episode.
That's right. That's right. I'm heading to Europe tomorrow. I'm actually going to be in Spain for a couple days with my wife. Looking forward to that. But then after that, I'm going on to Switzerland for work and a conference, and I'm going to have several meetings with clients and some people in the world of finance. So I'm looking forward to that.
Some top secret conversations about building bunkers on mountaintops. So look, going back to this idea of the price action that you've seen and some of the things that have gone on there, all of the stuff that you recapped from a year ago, the energy prices, et cetera, was really at the peak of this inflation scare. Now it seems like the worst of it is behind us. Anything can happen. But as far as the CPI data and a lot of the other things, most things seem to have retraced back to even pre-COVID. A lot of the commodities have seemed to have done that. So we now have maybe one of the things that's really been at the core of this violently sideways, which is what's the Fed going to do? What's monetary policy going to do? Because their real core mandate is price stability, and their boogeyman in terms of trying to control that is inflation. So if the markets keep running away with these animal spirits trying to front run the Fed, the likelihood that there's no pause, there's no pivot, and they're going to keep doing this until something really does break.
Yeah. So, I at the beginning of the year, the other thing I talked about is there's going to come a point this year, and I think it's going to come in approximately the late April, early May to August time period. So maybe let's just call it summer, where we're going to hit the peak in these year-over-year inflation numbers, right? And we're going to see a big drop in the year-over-year numbers just based on comps. Even if inflation remains elevated, we're going to see these big year-over-year drops. But it's also going to coincide with about the same time that these rate hikes that started a year ago are going to start actually showing up in the real economy. And I think that's kind of what we've had over the last month. The rate hikes that started a year ago now have finally started to show up. And the first place they started to show up was overseas. Let's just be clear about that. This all started last fall in Japan and England and China and Europe. But it hit the US here in February, and it manifested itself in the banks. And this bank story isn't over. But going back to what we were talking about, as we get into kind of the May time period into summer, we're going to hit the Fed is going to be in a really tough spot, especially if the markets are still at these levels, because we're going to see the year-over-year numbers are going to start to fall, right? Which will sort of give them pause that they don't need to do anymore, because the inflation will be on its way down. But you're also going to have, the year-over-year interest rate hike effects coming in. But if the markets are still high, then they've kind of, do they have to raise in order to keep animal spirits from just completely running away? Because if markets really run higher, the asset price inflation will feed into the other, consumer price inflation. Now, it's not one-to-one, and it's not exactly the same. But if asset prices are flying high, then companies are probably not going to be laying people off, right? So, but the labor market inflation has been sticky, And even today's inflation number that came out, the headline was a little bit soft, but when you look through wages, which is the thing that the Fed is kind of most concerned about, we're still very sticky. So I think Q2, this may be, one of these, sell in May and go away type years. I don't know yet. We'll have to see, but it's kind of setting up for that. I continue to believe that the easy money for the year has been made. I think the rest of the year is going to be very, very hard. I would have loved it if we went back down and already tested the lows from last year, and we could say we're now going to climb out of this. But we're still kind of near the highs, and I just think the easy money's already been made.
Yeah, and that's kind of another theme we've been on too, is the easy money has already been made. But another thing, speaking of the Fed, the timing of the high inflation prints and this year-over-year comparison, even if the inflation numbers are still elevated and compared to the Fed's target rate of 2%, it's, as you've mentioned before, another theme that I've really clung to a lot is, the markets are actually trading on expectations. So it's not the actual nominal value that matters. Yeah, even a 5% print could be high, but when you compare it to a 9.1% in July of last year, it looks like the Fed is crushing inflation. But to your point is, so then the attitude is, okay, the Fed has done enough. Like, look at you've got inflation under control. Everyone looking at like the Fed funds futures markets and various positioning that investors have made that suggests they think rate hikes are coming later this year at the end of the year. Well, if all they do is pause and there's no pivot, there's no change of direction, and they just pause, is that going back to kind of this thing you said just a moment ago? Is that now the new consensus? Earlier this year, you were nervous because, hey, things are looking like they're going to get bad, but everybody thinks that. Is the new consensus the Fed's going to pause soon and therefore markets are going to take off? Is that where everyone gets caught off sides again?
It's very possible, and it's very possible. And that's why I say, listen, I don't know what's going to happen. I just know it's a very uncertain time. And, I think, not to get on my soapbox too much, but if I can give a little advice to everybody is, don't worry about knowing everything. Don't worry about always being right. Nobody's always right. The idea that you can call the markets perfectly and never be wrong is ridiculous. And that's why I don't mind when I'm wrong. If I wasn't right more often than I'm wrong, then I wouldn't still be doing this after 25 years, right? So I've learned how to be more right than wrong, but that doesn't mean that I don't get things wrong. I'll give you a very good example today. And I always think these are pretty funny. We were coming into Friday on the last day of the quarter, and I knew the market would open higher because, they're trying to get a nice print to the end of the quarter. But I thought we would open higher, and then I thought we would sell off by the end of the day as, people kind of started to close down for the quarter. And so I tweeted out that, equities will be red by the end of the day, and we're going to have a really ugly day on Monday. And I still think that's the case. I think that the markets got way too far ahead of themselves today, running into the end of the quarter. They didn't close red. It's no big deal. I'm going to be okay. But people are like, ha, you don't know what you're talking about. You got it wrong. You know what? Who cares? And if I'm wrong on Monday, that'll be fine too. But my point is that I have a plan to how to get through what I think is going to be a very hard year. And I'm going to stick to that plan regardless of what the markets do. Now, will I have to adjust based on what the markets do? Absolutely. But you can't let the market bully you. The minute the market starts bullying you, you've lost. So you have to let winners go by without getting FOMO. Now, it doesn't mean you can't learn from it. It doesn't mean you can't pay attention to it. But I think the analogy I've used before is poker. The best poker players in the world play less than 20% of the hands. So they let pots go by all the time. They could play every hand if they wanted to, but they don't. And so people could get very far ahead of them. If somebody's on a hot streak and they're playing 3 or 4 hands in a row and they win 3 or 4 in a row, that person's ahead of them. But that poker player, that professional, he just sits there and waits. And then when he gets the cards, he goes in big and he wipes everybody out. And that's kind of the way I think you have to do it with the markets. You don't have to play every hand. You can wait and pick your spots. And I think if you're patient and you have discipline, and you've kind of been in the game for a while and kind of know what you're doing, you will recognize the spot. But you have to have dry powder when the spot arrives. If you don't have dry powder when the spot arrives, then it doesn't matter. Yeah,
and part of that trying to get everything right also has a little bit to do a little bit to do with trying or only focusing on things that reinforce those moments when you're right, or at least are reinforcing your bias. And that's been another big theme here is a lot of this clickbait headline jumping where people will grasp on the things that reinforce their bias because they're all in on that trade or they're all in on that ideology. And it not only does it cloud your judgment in terms of what's going on in the markets overall, but you end up blocking out any alternative opinions that could challenge that view, and you're only absorbing things that reinforce it, which makes you even more susceptible. And one of those in particular is this idea that with the BTFP, the Bank Term Funding Program that they came out with to kind of rescue the potential liquidity issues that banks were having by allowing them to pledge these undervalue, pristine collateral type assets like government bonds at par so they could get cash to handle depositor outflows. And everyone started treating that as QE, and that became this big argument. And one of the pushbacks that you had was that even if you thought it was QE, and even if it was injecting some form of QE or liquidity into the system, is it really worth all the hype unless you know the size of the hole?
Yeah, so, we always know. The big debate over the last year has been, will the Fed continue to raise or will they chicken out? And the point I've made is they've raised a lot more than almost anybody thought they would. And the pushback whenever I've said that is people say, well, it's not that we didn't think they would raise, it's that we didn't think they could raise without crashing the market. Okay, well, here we are. The markets are close to their highs. Now, did we had a bank crisis a month ago or over the last month? Not denying that, right? But if the crisis was so great, how were they able to raise rates, a couple days later? And why are markets now back at their highs? Now, is it because they're expecting to go back to QE or because of the liquidity they've jumped in? Potentially. But the point I want to make that you brought up was that if the Fed and the central banks are either reversing policy or providing liquidity or injecting stimulus, however you want to term this, they're doing it because there's a problem. They're not doing it because everything's fine. So if you think that what they've done so far is enough, then fine, go buy risk assets. But I'm telling you, the hole that they're trying to plug is much bigger than what they've already done. Now, it doesn't mean that they won't eventually do enough to plug the hole. But this hole is enormous. And it's not just in the United States. It's in Europe, it's in Asia, it's all over the world. And so, you don't want to go all in with half the information. I personally don't think it ever makes sense to go all in. To me, there's no reason to do it other than pride, right? And if you don't have all the information, then you certainly should not go all in. And I don't think the people that were claiming, hey, it's QE, let's just jump in the market, I don't think they have any idea how big the hole is. So, again, that goes back to we're in this market where we just don't quite know what's going to happen. But what I do know is that the risk associated with this market is bigger than risk associated with many markets in the past that I've been in. And so it's when I know the risk is outsized that I am more careful than other times.
All right, Brent, I need you to just take a deep breath. You and I have to have a little bit of a heart-to-heart. I know this is going to be hard for you to stomach and hear, but I just want you to understand that the dollar is going to die very soon, and the BRICS are going to be releasing a new global reserve currency backed by hard assets. So I know this is hard for you to swallow, but I wanted to be the one to break it to you first.
Well, you know what? This has been a week to remember. This has absolutely been a week to remember. And, one of the other things that I talk about a lot is, and one of my favorite hashtags is people are losing their minds, right? I will tell you this week, people absolutely lost their minds. With this whole de-dollarization, the BRICS are taking over, the dollar is doomed, America's days are done, get on board because the train is leaving. And part of me just has to laugh And listen, if you're of the opinion that this is real and it's going to happen and it's going to be a process and it's going to take time, but it's going to happen, then I think that's a very valid opinion. You do have to pay attention to this stuff. You can't ignore it. But you also don't have to accept every single word as fact and ability. You know, I've said this before. I have had a plan to join the PGA Tour for about 30 years now. And I've even practiced, right? But the likelihood of me competing with Tiger Woods or Phil Mickelson or whoever it is anytime soon, it's pretty low, right? But it's part Schadenfreude in that there's this almost, you know, romantic view is the only way I can describe it. There's this romantic notion that the U.S. is going to get what's coming to it, and this is going to be it. And so they glob onto this. Now, the first thing I want to say is, with regard to the BRICS currency, if you think that they're going to be able to provide a basket of their currencies, and they're going to mix it somehow, and it's going to allow them to do global trade that will compete with the United States, then I would say, why don't you own these currencies already? There's nothing stopping you from going out and buying this basket of currencies. You can even throw gold into it. But since the BRICS were formed in 2009, let me just tell you how those currencies have performed against the dollar. The Russian ruble is down 60% in that time. The Brazilian real is down 63% in that time. The Indian rupee is down 43% in that time. The Chinese renminbi is only down 1%, so it's held up relatively well. It's a pegged currency, but it's held up relatively well. And South Africa, where's South Africa on here? South African rand is down 50%. So, you know, now if you went out and you bought an equal basket of currency, those currencies in gold, you would be down significantly against the dollar. And by the way, when the BRICS were formed was almost exactly when QE started after the global financial crisis. So everybody who has said the dollar is going to die has based it on the fact that they've printed all this money in the form of QE. That started at the exact same time as the BRICS formed. And over that time, that's how those currencies have performed against the dollar. Not to mention the fact that global reserve currencies are not just about, you know, the dominant global military power. That is a big part of it. And I argue that should it come to that, the U.S. would use that military power to reinforce the global reserve currency. But right now they don't need to use it because the markets reinforce it. You know, the dollar is, we've said that it's the global currency of finance, or it's the global language of finance. It's what greases the world of global commerce. And it's backed by our markets, right? And it's backed by the global debt that everybody owes in dollars. So it's fine to pay attention to what the BRICS are doing. It's fine to understand that these are, you know, kind of historic times. I'm not denying the fact that these are important topics. But don't take every headline. I mean, it was just a week ago I said you got to come up with a plan so you don't have to trade every headline. Well, I guarantee you people were trading headlines this week. It was unbelievable.
Brent, that was quite a reserved response to that layup. But,
I was being nice.
Yeah. But one of the things I want to highlight too, that you've also, I think, mentioned, even just last week, I think it was, whenever these things come up, so we're talking about this whole BRICS thing and the idea that they're going to trade amongst themselves, not using dollars. But put that aside for a minute. Whenever these things come up, it's really, I think, valuable for people to step back and start asking some of the questions around why it's happening. And I think one of the things that's profound about potentially why this is happening, like you highlighted before, when China and I believe it was Iraq orchestrated a deal, it was mainly because the irony here is this is a conversation and this arrangement is happening because all of these countries are actually hoarding their dollars because nobody wants their actual currency. So I don't know if you want to add another layer to what you're just saying by highlighting that point.
Yeah, I mean, they're trying to get away from having to acquire dollars on the open market, right? I mean, one of the ways they acquire dollars is through trading with the United States. But the problem is is they then go out and they take out debt in dollars, because if they borrow in dollars, they get a lower rate. And then, when their economies don't perform the way they think it should, they have a hard time acquiring more dollars to continue to, to service that debt. So then they look for ways to do trade outside of dollars, since they can't get them. And they try to encourage their citizens to sell the dollars so that the central bank can buy them, so that the central bank can then use them. When the Ministry of Finance of Kenya recommends to his citizens to sell their dollars because the dollars days are done, it's because he wants those citizens to sell them to the banks, where the banks can then give them to the central bank, because the central bank desperately needs dollars. So I guess my point that I would make is, whenever people read about our local politicians, or oftentimes they'll read something from, if you're a Republican, then you hate the Democrats. And if you're a Democrat, then you hate the Republicans. And so when any politician that you don't like says something, you automatically think it's a scam, that they're lying, that you don't trust them. Well, I would suggest you hold that same level of contempt and same level of skepticism when you hear a foreign politician saying something. They're up to something as well, and it's not necessarily altruistic. And so you've really got to kind of think through what they're saying and why they're saying it.
Awesome. Well, look, it's been a good first quarter. A lot has been covered, and we recapped most of it on this Q1 ending episode. It is a Friday, and politicians, as you mentioned, are always up to no good. And perhaps next week, as we start the fresh quarter, we'll have some good political fodder, as maybe Trump will be in handcuffs. Who knows? We'll see what kind of drama that kicks up. But don't go hanging out with Stormy Daniels this weekend, anybody. And stay clear of anything like that can get you in trouble, and stay clear of all the things that we recommended you don't do on this episode. Keep an open mind. Don't be chasing headlines and falling in love with your bias and your ideologies. These are all things we've talked about all year so far, and we recapped on this episode.
Let me make a point. This will be good for me to do this at the end of the quarter here. You just reminded me of something. So I'm going to take 2 minutes, and I'm going to say this as a wrap up to the quarter. One of the things I've gotten back since you and I have started doing this, now this is our first full quarter doing this, right? And so some of the feedback I've gotten when I've done these, and when I interact with people on Twitter, or when I've given presentations, interviews, and I'll say, don't be so certain about everything. And people will say, well, Brent, you're so certain about the dollar. You're all in on the dollar. You don't have an open mind regarding the dollar. And the point I would say is, I absolutely have an open mind, and I can absolutely promise you that I have done as much work on this as anybody trying to debunk the thesis. I've spent the last 15 years trying to figure this out, right? And I don't claim to have all the answers, but I promise you I've thought about it, and I've thought about how I can be wrong. And the whole dollar milkshake thesis, and the whole reason I've pounded the table on it, is not to convince somebody to go all in on the dollar. The whole point of the dollar milkshake theory, and my continual, rebuttal to people who say the dollar is going to die, is to give you the information and the understanding for why you should not go all in against it. There's a difference between betting all in on something and betting all in against it. I don't think anybody should go all in on the dollar. Okay? I happen to think it would work out, but I don't think anybody should do that. What you should not do, though, is hopefully I've provided you some information and some reasoning why you shouldn't go all in against it. All these headlines that you've seen over the last week of the dollar's death, I can show you the same headlines from 10 years ago. I can show you the same headlines from 20 years ago. I can show you the same headlines from 30 years ago. Inevitable does not equal imminent, right? So keep an open mind, do your homework, have a plan, and don't trade from headline to headline.
Excellent. So for everybody, thanks for coming along on the first quarter journey with Brent and I. This is Milkshakes Markets Madness. You can find us online at milkshakespod.com. You can find Brent and I on Twitter, as well as MilkshakesPod on Twitter, using the handle at MilkshakesPod, which is also how you can find us on YouTube. So we appreciate everyone who's come along, all the likes, the subscribes, the views. Keep it up. We'll keep it up. And who knows, maybe 30 years from now, we'll still be doing this and still be making jokes about the end of the dollar. So Brent, I appreciate it, man. You have a safe trip, and we will hopefully be doing this with Snow Peak Mountains behind you, and maybe you'll be on top of it with a pile of gold. Who knows?
All right. Well, we'll see. We'll talk to you soon.
All right, man. All right. Take care.